Hello, everyone. Welcome back to another episode of Let's Talk Housing. My name is Brennan Thomas, and I am the co host alongside the Stephen Thomas, chief economist and founder of Reports on Housing. Today, we will discuss the most recent news and statistics, more on 2025, since it's just right around the corner, the latest Federal Reserve meeting, areas at risk, and so much more. This is going to be a good episode. But first, like usual, Stephen, what is going on in the Small Thomas household?
Um, it's a lot of holiday stuff right now. So all the kids, the elementary school first grader Zeke and our middle schooler Mason had the day off today. They actually because they need an extra day, so they have today off. And the other two that are in high school, they had their last final today, and they're home and officially enjoying their break. So right now, it was finals week. Everybody had lots of tests. It is done. And yesterday, Zeke, being a first grader, he put on this full-on suit that is a Christmas suit, and it was from a retro Christmas party that we went to, and he wanted to wear it yesterday to school. He did. And that's where it shows it's good to be a kid because he was still, he's secure in his skin, and he walked to school and was putting off a lot of attitude. And then, of course, the older siblings looked at it and go, he went to school looking like that? Of course, as you get older, you stop doing those things. But when you're young like that, you totally embrace the season. You don't care what people think. And I love that in first graders. So we got to see that in spades yesterday. It was pretty fun. But we're just getting ready for everything that Christmas has to bring for our family because it's a busy time of year. Starting with Christmas Eve and then Christmas Day, and just a lot of festivities and things like that, and a little time to relax and not work as hard. This is the time of year where things cool down a little bit. Other than, of course, we are writing all of our forecasts. We're going to have the written forecasts for all the various counties, but pretty much already have that in a presentation format. It's easy to translate that into the forecast that will be written that subscribers will get these coming up next 2 weeks. So that's what's going on with us and where everything's at. How about with you? What is going on with Brennan Joseph?
Oh man. Let's see. Arsenal has been doing somewhat decent now. Seems like we picked up a little bit of form, so I can't complain on that front. But outside of that, I went to a concert to see the main singer Robin from Fleet Foxes, and that was just absolutely amazing. I was like taken to a whole different planet being at that concert. It felt like almost like it was lasting forever, but at the same time, it just went by so quickly, and it was like such a neat little moment to be in that, I guess, space and hear that music that I just loved to listen to in college while studying for all my econ exams and marketing and all that fun stuff. So it was just a nice little trip down memory lane from what it felt like. But other than that, yeah, it's just a holiday swing. We're getting through everything right now, wrapping gifts and everything, which I'm not usually one to wrap, so I'm teaching myself how to do that this year. But outside of that, it's been a lot of fun. But Stephen, first, I want to talk about what's going on in the real estate world with supply, demand, and our very own expected market time over the past couple of weeks.
Well, these are the holidays, so the nuances are hard to detect when you're in the marketplace. It's just a slower time of the year. But what we're able to see in a lot of markets is it's just demand's coming down and inventories are coming down and market speeds. Some demand's coming down faster than the inventory, so the market's slowing a bit. And in many different markets, we have the inventory falling faster than demand, so it feels like it's getting even a little bit faster. It just depends upon your neck of the woods, your county, because each of these counties is kind of behaving a little bit different. But it's just towards the end of the year. I mean, inventories are falling because nobody's placing their homes on the market right now. It's home to the fewest number of homes coming on the market. It's December, and the further we get along in December, how many people are placing their homes on the market like right now? Like nobody is. It's the reverse. People are throwing in the towel, pulling their homes off the market, and fewer new sticks in the lawn. So we don't see as many for sale signs. And so then what we watch is inventories fall. And at the same token, demand really slows down. Looking for a home takes a back seat to the holidays, especially right now. So the combination of the two is we're just going to drive down to the lowest levels come December 31st, January 1st. And then from there, we'll bounce. And it takes a couple of weeks to get going for the buyers to enter the marketplace. That's because they have New Year's resolutions. Everybody's focused. There's not a lot of new homes coming in the market the first half of January. Those start coming on as January progresses. But once we get to the second half of January, that's where we leave the holidays behind. All New Year's resolutions are done. People are no longer going to the gym because they figure after 2 weeks that's too much. So they move on. And I know that you like to go to the gym. Usually by the time you get towards the end of January, all those people that decided to use that as a New Year's resolution go away and you don't have as many bumping into as many people. And that's instead of going and lifting weights, they're going to go look for a home. And we actually get demand really starts to spike pretty fast the second half of January, way outpacing any rises in inventory. As a matter of fact, inventory remains relatively fast. I mean, it's flat. So what you have is a flat inventory, maybe rising a little bit, but you have demand going through the roof. And then as a result, what happens to the speed of the market, it's getting faster and faster really quickly. And by the time you get to, I call it Valentine's Day. A lot of people say Super Bowl, but it really is closer to the end of February that we get our fastest market times by the time we get to into March. And so if I was to come on the market, probably February is one of the best months to come on if you want to match it up next to the fastest pace of the marketplace. But that's not when a lot of homes come on the market. They don't come on the market until the spring. So that's what's going on right now. We're kind of like in this holiday mode that we're going to come out of it, but it's not going to be until halfway through January. So we just kind of have to wait and see as to where things go.
And what has happened over the economy over the past couple of weeks, including that latest Federal Reserve press conference that we so had to watch?
Yeah, so prior to the Fed meeting this week, we've had a lot of hotter numbers. The expectations have been showing, and inflation not coming down as fast. There were a lot of the mixed bag of numbers, but most of them were mixed a little bit higher than expectations. So it showed that the pathway to get down to that 2% target that the Fed is so keen on hitting, which they said they absolutely want to hit the 2% target, which they made up in 2012. So it's not like it's been around forever. But the inflation wasn't coming down as fast. A lot of the numbers were, either a little bit too hot or right at expectations. Nothing was coming in less than expectations. And so as a result, then we also had the presidential administration change that's coming, that the election where it was going to be to a totally different party with a totally different, totally completely different policies, and those policies were what the markets were absorbing, and it was creating the sense that a lot of what you want to do with these, especially with tariffs, more than anything else, that's what Wall Street is most worried about. So investors, they invest with the mortgage-backed securities and longer 10-year treasuries and that type of thing. That what they're looking at is more volatility next year because they don't quite know how it's going to work out with this new administration coming in, and that's because Trump is really good at creating these different policies, and he says a lot and then ends up utilizing it for negotiations. But he says, no, I mean it. We're actually across the board tariffs, and that's scaring the pants off of Wall Street. So as a result of that, that's what this absorption and rates were a little bit higher. Then it was interesting to see what happened to the Fed because we wanted to see how the Fed would respond. They said in pressers and press conferences and different things that, you know what, they're going to wait and see what the data looks like before they make a move. However, yesterday was so important. It wasn't important because of the quarter point rate drop. That was already priced into the 30-year mortgage rates. 30-year mortgage rates realized that there was a 100% chance that rates were going to come down on a 0.25%. So So 30-year mortgages already had that cut in baked into the equation. What really ultimately what spooked the market, we got this giant rise in rates, was when the Fed met yesterday. They released their dot plot right as soon as Jerome Powell started to speak. And when he started to speak, you looked at that uh, dot plot, and that dot plot told us where interest rates are going to go next year and the following year. So 2025 and 2026. Now 2026 doesn't look as far off because we're about to be in 2025. So in a couple more weeks, that'll be a year away. And so we'll be very interested to hear what they have to say about 2026. But most importantly, I wanted to hear what they had to say about 2025. Now, while they sat there in a lot of different press conferences and said that they're not going to do much as far as price in a Trump presidency, they ultimately, that's what they ended up doing, and they ended up blaming it on the different market reads and stuff like that. But there was a lot of confusion in the press conference as well. We already anticipated there would be two rate cuts next year, not four. That was the big change, and it was already anticipated across the board. What wasn't anticipated, because then you saw the dot plot, and that was where the interest rates were going to go. It kind of matched that part of it. And it was weird that that's what the expectations were of Wall Street, but it had an immediate bump. But then, as Jerome Powell started to speak, rates started to climb higher, and 10-year Treasury people got spooked on what they were saying. Wall Street took a bath. All of Dow Jones, S&P, and Nasdaq all came down. So Wall Street had a big plunge yesterday, and then 10-year Treasuries and mortgage-backed securities, they too had a problem. They too had a problem. That problem was with what all of a sudden they were digesting the rate hike, but even though they were digesting it was going up, what Jerome Powell could have done in that presser is not said some of the things that he said that made it sound like, you know what, we're really not going to do much at all next year. We're kind of happy with where we're at. Everything's hunky dory. The overall market is a lot hotter than we thought. Labor market a lot better than what we thought, and and inflation is a little bit stickier. It's taking longer to come down. He's saying all these things, and it's an exact reversal of what they said in September. And what they said in November was kind of a cool down from what they said in September. And then yesterday's press conference was just off the wall. It was just it went back to, it was reminiscent of earlier this year in March and June and kind of those press releases. So it was one that when he started speaking, it was one that was confusing. It didn't sound like that there was much direction, and it was kind of like, you know what, we're just going to look to see what the numbers do, and then from there we're going to go ahead and make an update as to where we're going to go from here. But for now, we're pretty much not going to do anything unless we see we need to. So, but there will be two rate cuts next year. Is what they're kind of like talking about, and it was so wishy-washy that it didn't sound like they knew exactly where they're going to go. It didn't really relay a lot of confidence. And so as a result of that, that's where we saw rates continue to rise higher because the uncertainty was just getting people. Because then we had today, so that was yesterday, and then today we had PCE come out. And PCE is what the Fed likes even more than CPI, although he was answering questions and talking a lot about CPI. And it was kind of ticking me off a little bit because we knew PCE was coming out the next day. And it was like as if it was a shoe-in for it to be a certain way. Guess what happened to PCE today? That's another inflation read. It's just like the Consumer Price Index. It was less than expectations. So when you're less than expectations, and a matter of fact, if you look at core, if you look at push it out for like a year, it looks like we're practically at below 2%. So it was a surprise to the lower side, this PCE. And if we get another surprise to the lower side, which comes out then towards the end of January, that too, and this was way earlier than normal, and that's because we're going to go into the holidays. So they made this release. Next month it'll be towards the end of the month, like it normally is. And then when we get this, and if it shows continued coming down faster than what they thought. Now all of a sudden, inflation's coming down faster than what they thought. So in other words, it's like as if they have really no idea where we're going. So we have to look at all the data points, and the markets didn't like that. They didn't like the lack of certainty and the lack of direction that they gave, and it was more of a wait and see attitude. So because of that wait and see attitude, we had rates that came down, but today it went up. And then today we had rates that came down a little bit, and we're making our way back to that 7% because they shot up above 7% yesterday. And then after seeing what was going on today, you could see that it was going to give some of that increase back, and we're coming down. And it wasn't a repricing or anything. It was entirely because inflation is showing that, you know what, this wasn't quite as bad as what we thought. And then it'll be interesting to see from here. We're not going to have a whole bunch of data points going forward. The next big data point comes at the first week, the end of the first week of January, and we'll get that next jobs report. And that will be very important. That'll set the stage for 2025.
Now, earlier you mentioned something in regards to different administrations in the market absorbing that differently. Just to clarify for our listeners, can different presidential administrations impact the Federal Reserve's decisions versus the market itself?
See, this is where, while they said one thing, they did another thing. They said they're not going to be pricing in any presidential administration because they don't know exactly what policies will be done and to what degree, and a lot of that still has to be voted on by both the House and the Senate, and a lot of different that's what the speeches were going by the Federal Reserve. That's the way that they were stating their case. But then this looked more like, and listening to the presser, that they're kind of taking a wait and see attitude, and they're not going to do as much next year. And it didn't sound. It sounded more like they are starting to price in, even though they said that they're not, that they don't price in presidential policies, because those presidential policies haven't even been enacted. Matter of fact, President Trump has not even been installed as our next president of the United States yet. So it's like the market's making these moves ahead of time. I'm not for that. You can reposition as far as the market's concerned, but as far as stating that this is exactly what's going to happen, I don't believe it. I don't believe it because that's not how it happened during the last Trump presidency. That's not how it happened when even Biden was elected and all the different things he was going to do. Presidents say a lot when they're going to get elected, and once they get elected and they get there, they start changing their tune. And already, if you look at some of these different policies that they were talking about, they're already starting to change, and they're evolving because they're going to have to be negotiated. So that's what's kind of going on behind the scenes, and I don't think it's going to have as big of an impact as everybody's making it out to be. I want to see what's going to happen to these economic numbers more than anything else, and then let's make some policy, make some changes in policy if we need to on the Federal Reserve side, but don't price in these future policies that the president's going to have. That doesn't make a lot of sense, because quite frankly, when I'm looking at a lot of the data looks like it's pointing towards a slowdown in the future for the United States economy. Not a recession, but definitely a slowdown. But if they're not careful, you can get a recession out of this if they don't move fast enough to get down towards neutral. But the big argument is, so there's people that totally disagree with me on Wall Street, totally disagree with me. They do not feel that they're too restrictive in policy. We still do. There is a big group of Americans this affects, and it's not Wall Street. It's not those people. It's not the big companies and things. It is the on the streets, these high credit cards, these higher automobile loans, a whole bunch of different higher rates across the board that are going to be affecting the consumer, and the consumer is going to stop spending, and it's going to affect GDP, and it can definitely lead to a slowdown that will catch them by surprise because they're not doing enough, what we do, and that is looking at where we've been and then kind of like doing what I do. It's called linear regression, where we're trying to forecast based upon the pathway, what does the trend analytics look like? And I think they're missing the boat on that. And if anybody has their phone numbers or emails, I would be more than happy to send them some of my stuff so that they can clue them in on what we're seeing.
So we take a look at what feels like a million different things a day to keep tabs on the economy and mortgage rates and just all these different things. The catch is that we're not able to truthfully predict where mortgage rates will go. So, why is it so hard to predict, and why do our listeners and everyone that is involved with real estate need to be careful when reading all these different articles talking about mortgage rate prediction?
Yeah, so my mortgage rate prediction is from 5.75 all the way up to uh, really I don't really see a pathway up to 7.5, really about to 7.25. But you're not going to get there. It can happen anywhere in that range. There are so many institutions that try to peg an interest rate to a certain amount. I know NAR said 6%. Well, that's looking really wrong already. And this is where predicting where interest rates are going to be is probably one of the most challenging aspects of being an economist, and that's because the pathway forward is can only be seen once all of the different data points are released. And this is what everybody's trying to do. They're trying to figure out, okay, where does the data start to slow down, or where is it speeding up, and where is inflation going to be in the future? And if you look, this is what you have to understand. Like Fannie Mae does a economic forecast and a housing forecast every single month, and it's all over the board all the time. The Federal Reserve also, in that dot plot that they released yesterday, they released this big giant PDF that you can download off the Federal Reserve, and on that PDF you can actually see where they think inflation is going to be, GDP, a whole bunch of different things that they're now forecasting. But they're forecasting that on a quarterly basis. It's every other meeting, which comes out to once a quarter. But you can see it. You can see what they said last December, to what they said in March, to what they said in June, to September, December now. It is moves all over the place. So when everybody thinks that, you know what, they totally understand what they're doing and they've got it all dialed in, and they make it sound like they're all dialed in, they don't know. And they're all over the place. So just because right now they're saying, just two. You know what they said before? This year they've changed their tune. They said three at the beginning of the year. That's what they said in March. Then in June they said one. And then in for this year. And then in September they said four. People go, how can they do four? There's only 3 meetings left. Well, guess what? As of yesterday, they did four. And right now they're saying, okay, now we said four before for next year, and we kept on saying four, but now we're saying two. And what do you think is going to happen in March? Do you still think it's going to be two? Probably not. It's probably going to change again, and we'll see. And it's based upon all these numbers we're going to see from now to next March. And there's going to be a lot of data that comes out. So this is going to move all over the place. And as far as knowing exactly the way things are going to go, I listen to a ton of talking heads. Nobody knows. There is so much uncertainty out there, and the Fed didn't help anything yesterday. It just made it just like a big giant uncertainty, big question mark going into 2025. We have no idea exactly where rates are going to go. And for us, we know the big giant range where it's going to be, but we have an idea of where we're going to go from here.
So, as this year is coming to a close, we can now reflect on all the events and chaos that pursued. So, when looking back, one main thing sticks out to me in regards to real estate, and it's just interest rates. It's been talk of the town. It has been for quite some time. So, Steve, has interest rates affected this as it affected this last year? How can it affect this upcoming year for beautiful and upcoming 2025?
Yeah, it's been it's been a real roller coaster, and that's because everybody had anticipated that rates would be a little bit lower. They did go down a bit, and we were there for a while, and that was from July, middle of July through the middle of October. We finally got the rates below 7%, kind of where we would like to see them, and they got all the way down to 6.1%. But the problem was they only stayed down at those low levels for a minute. They were only for 42 days. That's it. We got rates less than 6.5%, and that's it. And that's the longest stretch that we had of rates below 6.5% in a super long time. When we got down to 6.1%, that was the lowest rate since February of last year, 2023. So we're not used to seeing these lower rates, and that really will ignite things, but that's not what happened this year. Instead, the big surprise was rates being too high. And this year was the rate. We've said it over and over again. The real estate market is at the mercy of rates. And really, everybody should be rooting for the economy to cool enough so that rates can ease, so the real estate market can ignite. If anybody wants to do anything in real estate, if you want to buy real estate, you want rates to drop. If you want to sell real estate, you want rates to drop. A lot of these homeowners that sell want rates to be lower in order for them to make a move. Otherwise, they don't want to trade in their really low rate for a much higher rate. But as rates come down a little bit, they'll go, all right, you know what? The trade-offs are I want to be in a new home. I'll go ahead and pull the trigger as rates come down so that they will go up. But they just don't want to go up. When it's in the sevens, it's really prohibitive. The closer it gets to six, the more movement we have. The more that it comes below six, even the more movement that we have. When it's above 7%, the whole entire real estate market is what I call frozen. And that's when we do fewer transactions. Even if we placed more homes on the market this year than last year, and had rates been below 7%, we would have seen those absorbed and we would have done more closed transactions. But the problem was we had them north of 7% during our spring and summer markets. And as a result, we had fewer transactions, and those extra homes that were coming on the market just ended up accumulating over time. And that's how we built this inventory this year. It would have been completely different had we had interest rates at below 7%. And it's going to be very important to watch where rates go from here. I'm not really that concerned that we're up above 7% right now. I don't like it, but I'm not that concerned right now because it's a patch of the real estate market that it is the slowest time of the year for the course of the next 4 weeks. And then it will speed up. So we have 4 weeks to fix things and get below 7% so it matches and we have a better rate environment in 2025. So we will be watching this very carefully because if we're stuck above 7%, again, it's going to be, rinse, wash, repeat. We're going to do the same thing all over again. And we are at the mercy of rates. We need it to thaw. So we need rates, the market to thaw. So we need rates below 7%.
For some areas in 2024, we had a stronger year in sales in comparison to 2023. However, that was not a hard goal to beat. With 2024 being slightly stronger, could we see an even better upcoming year for sales figures?
Yeah, what we actually saw is we got a lot more closed sales in the month of it happened in the month of November and it happened in the month of October. And the reason it happened in those 2 months is because we finally had rates that had come down to 6.1% and they were below that 6.5% for 42 days. That was enough in the economic engine to make things move. And then we were pretty much below 7% until recently. In October, it went up above, then it came back down. And then right now it's up above a little bit. But if we remain below 7%, we'll continue to see more pending sales, which translates to more closed sales. And that's what we've had. These last couple months have been absolutely outstanding, and it has more to do with rates than anything else is this extra push. So for the months of October, November, December, we're going to do more closed sales. This last quarter will be pretty juicy looking year over year so that there's juice, and that extra juice is everything has to do with that rate sensitivity. Below 7% is really going to fuel a lot of things. So that's what we're looking for going forward is for rates to match up a lot better. And I'm sure you've seen it. I mean, you've been doing this now for a year and a half. How do you feel about watching rates and predicting where rates are going to go?
It's literally impossible. So I'd go to your presentations and you'd say, I'd grab a beer with a buddy, I'd go look at a dartboard, and I'd close my eyes and just throw a dart. And that's my prediction for mortgage rates. Like it's that difficult. There's no clear path or certainty. You can just follow it along, which is why we urge people just to keep in check with all the different economic indices that come out. That way, one at a time, you can at least get a feel for where it's going that day. And eventually you can see, okay, maybe there's a direction. So that's sort of what I learned in this past year and a half. Thankfully, listening to you so much and all the people that we listen to, but it's a dangerous game to really try and predict mortgage rates because the answer is you can't. But so Steve, in an article written by Adam, the data analytics for real estate, they said some 578 county level housing markets were assessed for the most recent report. The analysis showed that California, New Jersey, and Illinois once again had high concentrations of the most at risk markets in the country, with parts of Florida also joining that mix. So, Steve, is California really at risk for this upcoming year?
Yeah, you have to be careful. There's one county in the Bay Area out of the 9 counties. There's none in Southern California, and it's just these tiny, tiny. There's so many counties in California. So it just looks good on this to talk about California as if it's California. It's all gonna go to hay in a hell in a handbasket. But you know what? At the end of the day, that's just California is so big that there's a couple, I think there's like maybe two, maybe three counties, and there are so many counties out of that 578 that are within California alone because of the size, the behemoth that is California. But all the markets we track, the Southern California is a big chunk of the state of California, and a lot of the population. It's not happening here. That's not accurate. We are starting to see that there could be some slowdowns, not necessarily in there. In some of them, they're getting very, very close to 2019 levels. But even at 2019 levels, we're not talking a whole heck of a lot of inventory. You have to be well above pre-COVID numbers for it to really slow down the markets, and that really is not that many areas of California at all. And the at risk are, it says New Jersey and Illinois, and they're just talking about these different metro levels. We know where the problem children lie. And it's pretty much in Texas and Florida. And then there's the state of Idaho. And it's everywhere where they ran up in price so much that they have price to give, and they'll still be way up over time. It's just that could be some people that bought recently that could be burned in the process that you have to be very careful with. That those are the people that are most at risk. But that doesn't mean that we're going to see any wave of foreclosures or big drops in prices or anything along those lines. And but it's a great analysis because there are some. And Adam's not out there to try to say, yeah, there's going to be this destruction of the housing market. No, they're saying that there are some areas that are at risk, and it's true. There are some counties, but 578, we have a 50 states, so you divide that, and that's a lot of counties per state. And some states don't have that many counties. You gotta drill down to the very small county level, and there are some problem areas, but by and large, most areas are not there. They're not at risk. So that's my 2 cents on what Adam had to say.
So, with those at risk areas or those problem areas, like you said, which we feel like are Texas and Florida and Idaho, can those places continue to struggle going into 2025?
Yeah, it just depends upon the pathway of rates, and so I really don't know. We have a forecast where we have three different forecasts. We have our base case, and our base case right now is between 6.5% and 7%. That range is where rates will be. So I think I remember. I think it was Housing Wire. They try to say, okay, what does that mean? They try to do the average of that. So I guess ours is 6.75 if you take the 6.5 to 7%. So that's what we're saying, 6.75. And that sounds about right going in as far as the base case. And yeah, we're a little bit higher right now, but you have to understand the way the Wall Street works, it works with extremes. So based upon this data point that was the Federal Reserve doing their release yesterday, the market overreacted. And I said this many, many times before. So what happens is there's a big overreaction in Wall Street. Whatever is stated, these different data points, when they first see it, they like to overreact to it. It's like that new car that you get and you get that first scratch. You overreact to it. Well, every single data point is that first scratch for all investors. So, but yesterday was the data point of the Federal Reserve, and it had something in there where they overreacted to it because it was too extreme, too much to put their head around, so they overreacted. You'd think that it would come down because of that overreaction. We haven't even had that yet. what the PCE was able to get everybody's thinking right, and it came down. So I think that there could be some follow through on Monday because they overreacted yesterday. So that's where we could see the 10-year Treasury and mortgage rates come down more next week, at the beginning of next week. So if we have rates that are below 7%, we're not going to get as much struggle in Texas and Florida. Now, if for some reason these data points come in and they're too hot still for the economy, then we can get some elevation above 7%. But that is what our secondary and third different paths are for the economy. Our main base case is 6.5 to 7. And then we have a case that we made for 6.5 and below, and that is if the numbers come out cooler, kind of like the PCE that came out today. And if we get a jobs report that's too light that comes in, because we're going to see some job loss in the new home sector coming forward sometime in 2025. Does it come as early as January? I don't know. We will see. But if it does, then we can actually see rates come down below 6.5. There is a pathway for it, just as there is equally a pathway for 7% to 7.5. And if we get stuck there, that's where we're going to have a problem. We will have a problem in Texas, Florida, and Idaho, and Tennessee, Nashville specifically. It's all those markets that there was a mass influx of people, and a lot of people drove up prices like crazy, to where some people are sitting on a lot of equity and they'd like to move someplace else. And so you're getting a lot of more for sale signs, and there's a lot more movement in those areas. And that's when you have this pendulum swings, and it's so far where values went up that the pendulum's starting to swing back because values went up a lot. Now, they went up a lot across the United States. In those areas, it was extreme. So they're just giving back some of the extremes, and that extreme will be given up, especially if we have rates that are higher than 7%. But like I said, I don't think we're going to be above 7%. I think 6.5 to 7% is our base case. So that will put it in an area where it's okay. It's not bad above 7. We could be better below 6.5, but we'll have to see where we go from here to see what happens with Texas, Florida, Nashville, Boise, Idaho, in that area. So it's like a wait and see that we're going to see because they can continue to struggle a lot, especially if we have a higher rate environment equal to this year where we struggled to get below 7%.
Well, thank you everyone again for tuning into another episode of Let's Talk Housing, and thank you, Stephen, for dressing up for this episode. I did not partake in that, unfortunately, but he's wearing a nice little Santa, or I guess Christmas hoodie, as you can say. That looks all nice and fashionable. But if you want to learn more about what's going on in the real estate industry across Southern California, Bay Area, Phoenix, Vegas, feel free to check out our YouTube or subscribe today at reportsonhousing.com. Please leave us a good review. And if you have any questions, feel free to post it to any of our social media platforms, or you can even email me personally at info@reportsonhousing.com. We will see you very soon, most likely in the new year. So have a great rest of your day and happy holidays. Thank you.
Thank you very much.